So today we're going to look at the international finance, money markets, and dividend policy. I've summarized these three units in one. So let's begin by talking about money. When you hear the word market, you might immediately think of the stock market. However, the money market is completely different. Here we are looking at short-term borrowing and lending. So what do we mean by short-term? We mean borrowing within less than a year. So now why is this money market very important? So money market is where short-term securities are traded, and these are used by government, banks, and large companies. So government and large corporations often have short-term cash problems. For instance, government may need to pay salaries next week, but the main tax revenue comes in 2 months. So what does government do? They'll need to find a way to borrow money quickly. So this is exactly what the money market involves. So let me walk you through the most common money market instruments. So we have what is called the treasury bills. We've heard of them. We have what we call the commercial paper. We have what we call the certificate of deposit, the repurchase agreements, the federal funds, the money funds. So treasury bills are issued by the national government, for instance, the US or Zambia, and these mature within a period of 3 to 12 months. So what is interesting about treasury bills is that they are discount instruments. In other ways, you buy them for less than their face value. So at maturity, government will pay you the full price, and the difference is your interest. So if it's a treasury bill worth 300,000, you buy it for less, maybe for 250, and you're paid the actual 300. We also have a commercial paper, which is very similar to the treasury bills, but there's only one key difference here is that the commercial paper is issued by large companies, not government. For instance, we have the big mining giants here, FQM. They might issue a commercial paper to pay for inventory. So it is also sold at a discount and it is redeemed at face value. However, because companies can fail, a commercial paper is riskier than a treasury bill. Governments do not fail. We have what is called also a treasury, a certificate of deposit, a CD. Is something that you might see at your local bank. So it's a time deposit. This means you agree to leave your money in a bank for a fixed period, say 6 to 1 year. In return, the bank will pay you higher interest rate than the regular savings account, but you need to be careful. If you withdraw early, you'll be penalized. So that is called a certificate of deposit. We also have what we call a repurchase agreement, others say repos. It sounds complicated, but it's actually a very simple. A repo is simply a very short-term loan, often just for a day. Now see how it works. So one party will sell securities to another party, and simultaneously they will agree to buy them back tomorrow at a slightly higher price. So the difference is the interest. So repos are very popular among banks and they trade overnight cash. So you have this need for money and you want to, you know, you have an immediate need for it. So that's what we call a repos or repo agreement. So we also have what are called federal funds and money funds. What are federal funds? What are money funds? So money funds are simply pools of money from many individual investors. And we have a fund manager who takes that money and buys all instruments, like I mentioned on top, the treasury bills, the commercial papers, the CDs, the repos, to enable these small investors afford um, access to the big markets. Okay, so we move on. You now need to understand some distinctions. We have what are called discount instruments. We have what we call accruals instruments. Okay, what is a discount instrument? Discount instruments are issued below the face value. For instance, you pay 950 for 1,000 kwacha treasury bill. So at maturity, you get 1,000. So your profit is what? Is a 50 kwacha. And then accruals instruments. These are issued at face value. For instance, you pay 1,000 today, then interest accumulates over time. So at maturity, you get your 1,000 plus interest on top. So these are the two principles that we are actually looking at on top. So both types will pay interest at maturity, but in different ways. So you must keep this in mind. So we now go to the international trade and foreign currency. International trade and foreign currency. So why do companies invest overseas? And what kind of risks are there in international trade? Why do companies intend to invest overseas?
Um, Usually for various reasons. Technology is one of them, labor is another one, a wider market. Maybe they're looking for new markets. They'll do that. Yeah, so that's some of to diversify as well.
Okay. Oh, okay. So that's very true. Companies would want to invest overseas for many reasons. So they would want to access raw materials. For instance, oil companies would want to invest where there's oil. You can see how these wars are erupting because US wants to invest where oil is found. Sometimes cheaper labor, many companies move to China or Vietnam for this reason. They also want to access markets. So Japanese car companies, they build factories in Europe to avoid what import taxes. So also to access knowledge. For instance, Microsoft, they set up a research center in Cambridge or England to tap into the local expertise. Also favorable taxes. Sometimes you may want to invest in a foreign market whose taxes are low. And political stability. So Hong Kong, before Hong Kong returned to China, many Hong Kong firms invested in Australia and North America to protect their assets. But international trade comes with risks. So in addition to normal business risks, there are two major risks that are involved when trading overseas. What risks do we know of? So we have political and foreign exchange risk. So political, you can call it country risk and currency risk. These are two main. So political, this is a risk that a government will pause on your business transactions. Okay, the risk that something harmful will happen to your business. For instance, the government might what? Expropriate your factory or take it away without any compensation. We see how the vendetta, the KCM issues were, or impose new taxes or regulations, or block you from taking profits away from the country. So this political risk, country risk, may also have the risk which we call the foreign exchange risk. This is a risk that changes in exchange rate to harm your profits. So this is a huge problem for international companies. There are actually three specific currency risks that you need to know. We have what we call transaction, translation, and economic risk. Have you heard of them? Transaction, translation, and economic risk. So what is involved in the transaction risk? So you agree to um, pay a price today. You agree on a price today, but you pay later. So the exchange rates move in between. For instance, a German company, they may agree to pay a German supplier 10,000 euros in 3 months. So if the kwacha weakens against the euro, the company will need more kwacha to buy the same um, 1,000 or $10,000. So that is a loss. So we call that a transaction risk. So where you agree and the exchange rate fluctuates. So it's an example of currency risk. We also have a translation risk. You own assets in another country. So when you convert their value back to your home country and the value changes on paper. So for instance, an American company may own a factory in Japan worth 1 billion yen. So if the yen falls by 10% against the dollar, the factory uh, is now worth 10,000 or 10% less in the American dollar. So there's no cash loss, but the balance sheet looks what? Worse. We also have what we call economic risk. This is a long-term competitiveness. So long-term competitiveness here is damaged. So if a Japanese yen becomes very strong, the Chinese goods also become expensive for American buyers. And therefore, the Chinese exporters will lose sales to their competitors in Vietnam or in India. So we now get practical to understanding how to convert currency, so exchange rates. We have heard of what is called a spot rate. Okay, so the spot rate is for immediate transactions. However, immediate in banking usually means two uh, business days. Now, let's look at a simple example from our Zambian bank where we see a US dollar, the bid price is 12.9035 and selling, which is the ask price, is 12.9535. Notice something important here. The bank buys at a lower price and sells at a higher price. Why? It's because the difference or the spread is what the bank profits from. So you need to remember this golden rule. If you are selling foreign currency to the bank to get a kwacha, you use the buying rate. But if you are buying foreign currency from the bank to pay with kwacha, you use the selling rate. So we can do some quick calculations here. You work in a bank with 100,000 US dollars and you want kwacha. So you are selling dollars to the bank. So what are you going to use? You use the buying rate of 12.9035. So our calculation will be as follows. So let's calculate. We have what? Buying and selling there. So you have 100,000 US dollars. You want to get kwacha. So you're going to multiply this 100,000 US dollars times the 12.9035. So meaning we are going to get this amount in kwacha. All right. So now suppose you need to buy US dollars for a business trip and you have 3 million kwacha. So you are buying dollars from the bank. So you're going to use the selling rate. The selling rate is 12.9535. This one here. So what are you going to do to get your kwachas, uh, your dollars from the 300,000 kwacha? So what you're going to do is you're going to use a selling rate. So your calculation will be to divide the 3 million by 12.9535. So you're going to get 231,589. So now, what is the bank's profit in these two transactions? How does the bank profit in these two transactions? So let's look at transaction one and transaction two. So we bought for 9.3035, okay, and you sold for 9.9535. So the profit is the difference. So you multiply the $100,000 by the difference, okay? Are we following? So the profit that the bank is actually going to make is the 10,000 times the 0.05. So they're going to make a 5,000 kwacha. So in transaction two, the bank sold for 95.35 and it would buy them for um 90.35. So the profit per dollar will be 0.05 kwacha. You multiply that by the total that we made, which was 231 US dollars. So what you're going to get is actually 11,579.45. So the bank made a total profit of 16,579 on these two transactions. So what determines exchange rates? What determines exchange rates? We have four key theories in understanding what determines an exchange rate. So we've been hearing exchange rates. So number one, the purchasing power parity. So this is a theory that says that um, a basket of goods should cost the same in different countries. So for instance, if McDonald's burger costs $5 in the US and £5 in the UK, then the exchange rate should be $1 to £1. But the inflation is high in the UK. The pound should weaken. So therefore, the purchasing power parity links inflation and the exchange rates. The second theory is the interest rate parity. So this theory simply says that the difference in interest rates between two countries should equal the difference between the spot rate and the forward rate. Question, why? The answer is because investors move money to where interest rates are higher, and that increases the demand for that currency, and so it appreciates. So the third theory is what is called the Fisher effect. So this theory was named after the economist Ivan Fisher, who says that higher expected inflation will lead to higher interest rates. In other words, lenders will demand compensation for this loss in the purchasing power. Then the fourth and final um, theory is the government intervention. Sometimes central banks actively buy or sell their own currency to influence its value. So, for instance, if the kwacha is falling too fast, what happens? The Bank of Zambia might sell US dollar to um, its reserves and buy its kwacha to support it. So these are the three theories. Now, I want us to look at an example on the exchange rates so that we can practice one or two things. So exchange Any questions before? Okay, exchange. Questions to do with exchange rates. Uh, Usually asked. Questions so far? Okay, let me check in the other pamphlet. So I'll give, if you don't have questions, I'll give you um, a question to try. So here's a question I want us to try. One, um, here's question number one. Number two, you're given the following question. The dollar is showing you this as a bid price and the ask price is this. And a Zambian importer needs to buy 50,000 to pay for goods from USA. The importer has sufficient kwacha in the bank. Number one, identify the correct rate for this transaction. Number two, explain why the bank uses a different rate for buying um, and selling, and the compute the total kwacha cost for the importer. Okay, so the first part, can somebody try?
The first part will be the selling rate. Since this Zambian importer needs to purchase $50,000, so it
Mm-hmm.
means, as you said, when it says buying, it means the bank is buying. Then selling, it means the bank is selling the dollars. So since the importer wants to purchase the dollars, this will mean that the bank will be selling the dollars. So the correct rate will be the selling rate or asking rate.
Exactly. So the ask rate of 19.9535. So why different rates for buying and selling? Why do banks use different rates buying and selling? because it's from the difference that the bank makes their profit or commission. We call it spread. So the bank buys low at 90.35 and sells high at 95.35 to cover on costs and make the profit on each transaction. Okay, then lastly, what is the total kwacha for the importer? What is the total kwacha for the importer? We're going to multiply 50,000 times what?
We're multiplying by the asking price.
We're multiplying by the asking. Is she correct? He's not asking me. He's asking everyone. Okay. So you multiply the 50,000 times the 12.9535. Okay. Um, whilst I'm looking for the other exam question, because here we need to understand what's happening. A scenario question can be given. Okay, so I'm supposed to now look at the dividend policy. We'll look at this question here, then go back to our notes. So HPT Resources Limited expects a capital expenditure of 40,000 and a net income of 34.4 million. It follows the residue approach, which suggests a debt to equity ratio of 3 to 5. What's the company's dividend payout? If the company places the same value of 1 kwacha of dividends on 1 kwacha of capital gains, then a firm cannot increase its value by changing its dividend policy. Explain why small, rapidly growing firms have recently gone public, almost always have a payout ratios of 0 if dividend policy is irrelevant. And Finance Solutions is planning to raise fresh equity capital and choosing between underwritten cash offer and right offer to its current shareholders. The goal is to maximize the current shareholders' wealth. What is the recommendation and why? This question is coming, so you need to understand where the lecturer is asking you to look at. So I'm going to look at the dividend policy, chapter part 4. Maybe before then I'll look at hedging and currency risk. Then I'll go back to the question that we have been asked. Okay, so how do we protect against currency risk? We call that hedging. So now that you understand the risks that are involved, we can talk about solutions. So hedging is simply reducing or eliminating your exposure to the currency risk. So the most common methods that are used, number one, we have what we call forward exchange contracts. So this is the most straightforward method where you agree with your bank today to exchange a fixed amount of currency on a fixed date at a fixed rate. Therefore, you know exactly what you pay or receive. So here, most companies are dealing with this to avoid the fluctuations in what? In the currencies, in the exchange rates. So even if the market moves in your favor, you cannot also cancel the contract to say, no, how come I'm paying the old? So you're obligated to go through it, whether it's good or bad. The second method is what we call currency options. So it's an option that gives you the right, but not the obligation um, to exchange currency at a set price. So this is more flexible than the forward contract. For instance, you may have an option to sell dollars at 13 kwacha, 13.0 kwacha. But when the market rises to 14, you simply let the option expire and sell it at that better market rate. Of course, you need to pay a certain fee, a premium for this flexibility. The other method is on the money market hedge. Money market hedge. So money market hedge, what happens? So the money market hedge, this is a little bit technical. You borrow an amount in a foreign currency, which is equal to what you will receive in future. Then you immediately convert that borrowed money into your home currency at a spot rate. And later you receive the foreign currency payment. Then you use it to repay the loan. So effectively, it locks um, the exchange rate today. So what they say, number one, you borrow an amount in foreign currency, like the US, okay, to what you will receive in the future. Then immediately convert that borrowed money into your home currency at the spot rate. Later, when you receive the foreign currency payment, you use it to repay your loan. So you're looking at the differences in the interest. Then you have the fourth method, which is called a currency swap. It's simply an exchange of two currencies between two parties. So you agree to reverse the exchange rate at a future date. So it's very common for companies that have long cash flows in foreign currencies. Then we have what are called leads and lags. Leads and lags. So the leads and lags here, basically, is a very simple strategy. If you expect a foreign currency to become more expensive, so you will lead by paying early your bills in that currency. But if you expect the foreign currency to become more valuable, so you will lag, meaning you are going to delay receiving your receipts in that currency. But this, however, works if you have flexibility in your payment terms. So, in a nutshell, what have we said? We've talked about a forward contract. How does it work? You lock in your rate today. You lock in a rate today for a future date. So it's best when you know exactly the amount and the date. We have talked about the currency option. How does it work? Right now, it's not an obligation to exchange. And when does it best work? When the date and amount are uncertain. Also looked at the money market um, hedge. You borrow now and you repay with a future receipt. So when does it best work? When you have access to the money markets. The swap, how does it work? You exchange and reverse later. When does it best work? When you have long-term foreign cash flows. Lead or lag, you pay early or delay receipt. When does it best work? When you have flexible payment terms. All right. So now we go to the dividend policy. Dividend policy is what we now go to. What is a dividend policy? Why is it important? We talked about the important stakeholders who are the shareholders. So by returning cash to the owners. So a dividend policy, finally, we need to understand what is a dividend. Simply put, it is a distribution of what? Company's profits to the owners or the shareholders. So dividends can be paid in cash or in additional shares of stock. However, there's a very important point we need to understand that companies are not legally required to pay dividends. Some companies, they pay them regularly. Some companies, occasionally. Others never pay dividends at all. So there are different um, dividend policies that exist. All right, so let's look at examples of dividend policies that exist. But before we look at them, we can maybe we'll look at the views on dividends that exist. So we have different types of dividends. We have what we call General Electric, okay, Microsoft. Okay, examples of dividends. I'll talk about them, but I'm just looking at different types of policies that were adopted by different companies. So we have company like Microsoft. They went public in 1986. They did not pay their first dividends until 2003. General Electric Company paid dividends continuously ever since 1989. We have a company called Heckscher. It never paid dividends at all. So we have three competing views that exist on the dividends. So there's a long-standing debate in finance about whether dividends affect the share price. So let me summarize these three views. So number one, we have view number one, which is called the dividend policy. It assesses a dividend policy is very irrelevant. So according to this theory, they view that is associated with the M and M. Okay, McNally and Miller, they say that dividend policy does not affect the share price. Why? Because if a company pays a dividend, the share price drops by exactly the amount of the dividend, and therefore shareholders are no better off. Only investments decisions will matter now, not how you finance them. So this first theory of view simply assess that dividends are what? Are irrelevant. So the M and M, they say dividend policy does not affect the share price, only investment decisions matter. The second view is that dividends, high dividends are good. And we look at what is called the bird in the hand theory. So this theory basically, which is argued, is say that Chintu Chintu Mwene, bird in the hand, has a sure dividend today. So over two in the bush. So because dividends are less riskier than capital gains, investors will pay a premium for high dividend stocks. Consequently, share prices are higher. So the dividend theory says that a bird in the hand, so it's better than two in the bushes, what is uncertain. So because dividends are less riskier than capital gains, investors will actually pay a premium for high dividend stocks. And the last theory is that low dividends will increase what? Uh, Share price. So this theory argues that in many countries, dividends are taxed immediately as ordinary incomes. So capital gains are taxed only when the stock is sold and often at a lower rate. So investors therefore prefer low dividends but high capital gains. And as a result, we have low dividend stocks that's at a high premium. So we have other real world factors. In reality, dividend policy is influenced by several other factors. What factors affect dividend policy? Number one, we have what we call the clientele effect. Number two, we have the information effect, the legal and liquidity, earnings and stability. So these are some of the factors that will affect the dividend what policy. So clientele effect here assess that different investors will prefer different policies. For instance, retired living people who would want to be on a fixed income that will pay higher dividends. And both investors in high tax brackets will prefer low dividends. Second reward factor is on information effect of signaling. So when a company increases its dividends, the market sees this as a signal that management expects higher future earnings. So consequently, a dividend cut is seen as bad news. And therefore, companies are very reluctant to cut dividends. Then legal restrictions in some countries, you cannot pay a dividend out of capital. So you can only pay from the retained earnings. And also, debt contracts, they will often restrict the dividends to protect the lenders. Then the other real world factor that will affect dividend policy is liquidity. So a company may show large accounting profits but very little cash. For instance, if a company is growing, they might have all its cash tied to inventory or receivable. Therefore, it cannot pay dividends. Now here, important dividend dates that are critical to any investors. These dividend dates are important. Number one is what is called the declaration date, the ex-dividend date, the date of record, and the payment date. These are important to investors. What are these dates? So the declaration date is here the board of directors will announce the dividend. Then the ex-dividend date is usually 2 business days before the record date. So if you buy stock on or after that date, you do not receive the dividend. So the seller will receive it instead. Then we also have the date of record. The date of record, here the company looks at the shareholder list and everyone on the list gets a dividend. Then we have what we call the payment date. The company will mail the dividend checks. So we have alternatives to dividend, cash dividends. Companies may have other ways to retain value to shareholders. How? By what is called stock dividend, stock split, stock repurchase. So these are some of the ways that companies may have for uh, their shareholders to benefit from. So what is a stock dividend? What is a stock split? So a stock dividend, where the company gives shareholders additional shares instead of cash. For instance, or give them 10% stock dividend, which means you get 10 new shares of every 100 that you already owned. So the share price falls proportionally. So you deal with that. So your total worth does not change. However, you have more shares. Then we have what we call the stock split. It's also similar to dividend stock here, but larger. So in a 2-for-1 split, each existing share becomes two. So here, the share price is cut into half. But why do companies do this? They make the share price more affordable and available for small investors. For instance, if a stock is trading for 10,000 kwacha per share, so many investors can't afford that. So they can offer a 2-for-1. So split it into 5,000, which is more accessible. Another alternative would be a stock repurchase. So instead of paying cash for dividend, the company will buy its own shares from the market. This will reduce the number of shares standing, and therefore the earning per share will increase. And the remaining shares will now own a larger piece of the company, and buybacks are often more tax efficient. Now, let's go to our exam questions. So I looked at this question that has come several times. I just want you to just get a glimpse of how to answer such questions. Okay, so we are told that HPT has what? Has a capital expenditure of 40 million and the net income of 32.4 million. It follows a residue approach with a debt to equity ratio of 3 to 5. What is the company's dividend payout? So what are we given in this question? What is given in this question? Number one, we've been given what? The capital expenditure of 40, then the net income or profit available of 32.4 4, and the debt to equity ratio of 3 to 5. So we first need to understand what the residue dividend approach means. So under the residue dividend approach, a company will first use its net income to fund any new investments that are needed. However, it doesn't use 100% of the income. Instead, it maintains what is called a targeted debt to equity ratio. So this means that for every, in this case, 3/4 of debt here, it will use what? 5 of equity to financing those ones. So here, let's look at the information that has been given. Been given our 40 and our 32. So this is our what? Our expenditure or investment needed, 40, and our 32 is our net. So we've been given the debt to equity ratio. So meaning we calculate this as follows. Debt to equity ratio is what? 3 to 5. So remember how ratios are done. We'll add this up. So 3 plus 5 is 8. So we're going to have 3 over 5. And we also have 5, 3 over 8, the total. Debt to equity ratio. 3 plus 5, 8. Okay. Okay, so the equity needed, we have total of 40. So how much equity is needed? So we have the component of equity, which is what? 5 here. And the total amount needed is 40 million. Expenditure, that's the investment, 40 million. So what is so the debt aspect is this, the equity aspect is that. So what do we get when we multiply that?
You have 25.
25. Okay. So 25. Then how much income do we have? This is our expenditure. Capital expenditure 40. And our income is how much? It's 2.4. So the residue income after we remove, because that's 25 million, means the company will use the 25 million to finance what? To finance the equity portion of this new investment. So we are going to subtract the 25 from the 32 to calculate our residue. What is our residue? 32.4 minus 25 million. So from our income,
7.4.
32.4
We have 7.2.
minus 25 million, which is 7.4. Okay. Then what is that 7.4? That is our residue income. So the 7.4, we need to calculate now our payout ratio. So the dividend payout ratio tells us what percentage of our income is paid to our dividend. So that's 7.4 out of the total income is the payout ratio. So 7.4 payout ratio. 7.4 over what? Over 32.4 times 100. What do we get?
Of 22.84%.
22.84.
84%.
Okay, that's 2.84%. So this is what we call our payout ratio. Can I go through this again? So we have a debt to equity ratio of 3 to 5. So meaning our total financing is 3 plus 5, which we get 8 parts. So the debt is how much? 3 out of 8, and the equity is how much? 5 out of 8. Altogether, we start from this debt to equity ratio. What does it mean?
Sorry, Colin. Sorry to take you back. Where did you get the 8 from?
That's where I'm going. Okay, that's where I'm going. Let me explain this again. So we're looking at this question here. I want to calculate the payout ratio. So I'll take my time because such questions are often repeated. So what are we given in this question? Number one, we're given that HPT expects a capital expenditure of 40. So this is our expected expenditure. Okay? And the net income of what? So income of 32 million income, net income. So we have what we call the debt to equity ratio of 3 to 5. So meaning for 3 to 5, that is our ratio. So this is where we are starting from. So what does this mean? The debt to equity 3 to 5, meaning the total financing has 3 plus 5, which is 8 parts. So you add these two. So this is the debt to equity. When you add 3 plus 5, you're going to get what? 8. Okay? So now, of this 8, which one is debt? 3 out of 8. And which one is our equity? 5 out of 8. Are we together so far here? Are we together? So it means the proportion of debt is 3 out of 8 and the proportion of equity is 5 out of 8. Now, we need to calculate the equity needed for the investment. Our expected expenditure from the 40,000, which one is the equity portion of it? 5 out of 8 times 40. So of the total expenditure, 40, the proportion of equity needed is what? 25. Because when we multiply this one, we're going to get 25 million. Are we together so far? So we now determine the um, residue income available for dividends. So when our net income, because it's from the income that our dividends are paid, we need to remove the proportion that should be is needed for investment. That we need to take away from our income, what we have available. So from our 32.4 income, we're going to subtract 32.4, subtract this 25, we take it away because our idea is supposed to pay out all these 32.4 to the um, shareholders, but this component has to go for investment. So we remain with what? 7 point, remain with 7.4. So this is the residue income that remains from the 32 million. Now we're being asked to calculate the payout ratio, the dividend payout ratio. The dividend payout ratio is simply the residue income available for dividends out of the total income that we had. So it's 7.4 divided by 32.4. Divided by 32.4 times 100. Okay. What do we get? We get 20. I don't know what you got.
4%.
Pardon?
22.8.
22.84.
Okay. 22.8. So that is what we call the payout ratio. So in simplicity, HPT resources made what? 32.4 million profit, but it cannot pay all of it because first it needs to invest in the business. So what does the company do? It plans to invest 40 million in these new projects. But again, the 40 million is decided according to our policy that these 40 will be funded as follows. The debt in Congolese, we're going to borrow, we're going to get three parts. Okay. And equity, if we're going to use our own monies that we have, which comes from the profits, we're going to use five parts. Okay, if you want, you can say you can use percentages, 3 out of 8 and 5 out of 8. Okay, whatever we have. So that part of the profit must come. So what happens now, the profit? So the profit of 32.4 million that the company has, okay, the 25 million must be kept for investment, and the remaining 7.4 is the leftover. So that leftover of 7.4 million is what the company pays. So only 22.8% of the profit is paid to the shareholders as dividends. So the rest, 77, is kept and invested in the business. Is that clear now? I was still lost. Is that clear? Can I hear some response? Okay, so the other parts theoretical. Maybe from what we have learned, you can try to explain. So here we are taught the following. That if the company places the same value of 1 kwacha of dividends as 1 kwacha on capital gains, then a firm cannot increase its value by changing its dividend policy. Explain why small but risingly increasing firms recently have gone public, almost having zero payout ratios if dividend policy is irrelevant. Remember, we talked about the theories of dividends. Okay, one being dividend irrelevance theory. What does it say? That investors don't care how they get money. That dividends or cash now or capital gains, which is share price, will increase later. So changing dividend policy does not change what? The company value. Now, question is, why do small, fast-growing firms pay zero dividends? Because number one, they have many investment opportunities, which is growth, and they need a lot of money to expand. So paying dividends would mean less money for growth or needing to borrow to raise funds, which can be costly. So in simple terms, small companies will keep all the profits and reinvest them to grow faster. So investors are okay with this because they expect what? Future prices instead of dividends, receiving them now, eating. So fast-growing firms, in short, don't pay dividends because why? They can use the money to grow, which is beneficial than borrowing. Is that clear? Then Finozent Solutions is planning to raise fresh equity and choosing between an underwritten offer and cash rights offer to current shareholders. The goal is to maximize current shareholder wealth. What is the recommendation and why? Okay, so to start with, we must understand that the goal of shareholders is to maximize wealth. So, and there are two options that have been given here. There's the underwritten cash offer and the rights issue. What is the underwritten cash offer? This is where shares are sold to the public and the new investors can buy, and the existing shareholders may lose control. It may dilute their absolute control. Okay? And there's also what we call the rights issue. The rights issue is a situation where you offer the existing shareholders to have the first chance to buy shares, and usually at a discount. So which of the two would you recommend? Would it be um, um, underwritten offer or underwritten cash offer or um, rights issue? I've explained what each of these talk about. What would you recommend of the two options? We are being told that the company is considering two options. Okay, if you know that, is planning to raise what? Equity, and it has to choose between two options. There's what is called the underwritten offer and the rights. And if the company has a goal of what? Maximizing the shareholder worth, which one will it go for? So the first thing you need to know is first to explain what each of them is. So of these two options, we have what we call the underwritten cash offer. This is where they use an underwriter to have their um, shares sold on the general public using an IPO. Then you're going to have new investors to buy. When they buy that, the existing owners may not be the absolute owners now, they are new owners in there, so they will dilute what? The ownership. Then there's a rights issue now, which now happens. So the existing shareholders within the company, so the company will say, okay, we are going to offer new shares to you, but you are going to be the first people to buy them, but at a discount, not at the normal price. So which one of the two do you think, looking at the situation that Finozet has? Okay, would it be the rights issue or choose the first option, the underwritten offer? So it depends on how you understand it. But I would recommend the rights issue, number one, because it will protect the shareholders from dilution and they can buy more shares and maintain what? Control. Okay, or they can sell their rights and still benefit. So here we're going to have a lower cost than the public issue, where you're going to have legal fees. It's also fairer to the current owners. So in simple terms, the rights issue will let the current shareholders keep what? Their ownership and will benefit directly. So it will protect their current wealth. So this is how the 25 marks were supposed to be gotten from this question. Thank you so much. It's been a very long class.